Welcome to our second video in the Market Matters education series. I'm joined again by James Gerrish. James, welcome.
Thanks, Nick.
James, today what we want to talk about is how we manage our cash position in the market. Now, since we started Market Matters in 2013, I'd have to say this has been part of the reason why we've been able to be liquid when the market to buy, and also, experience good periods in the market when the market tends to rally. Now, we've done that by going to very high levels of cash, when the market looks a bit volatile. An example was in 2015 where the market tried to get through 6,000 three times and didn't manage to do that. We actually moved to about 50% cash. Market corrected, came all the way back to 4,800 was the low. We were buying a bit early. We bought a little bit at 5.4, bought some more around 5,000. We actually did put our last amount of capital in at what was pretty much the low, and I think we almost went limit long the market at that point in time. Coming to today, more recently, we're sitting at about 12% cash. You have indicated in our sort of recent reports that we're probably going to sell a little bit of CBA. We're probably going to sell maybe some Ramsay Healthcare, and there is potentially one or two other stocks on the chopping block, given this is a seasonally strong period, but leading into where we think it will be a weak period. And then I guess we'll follow the process again and allocate capital at lower levels when we're happy to buy. So I guess talking very broadly, but for investors out there, just want to take a trip into the psyche and the reason we manage our cash level like we do.
Okay, so first of all, the major point I'd make is cash gives flexibility, but you don't want to have, cash is also a burden at times as well. So you don't want to be sitting in too much cash when the market's rallying, and you don't want to be having too little cash when the market's falling. That said, we're not. It's really hard to pick market tops, and it's really hard to pick market lows. So you sort of have a bullish bias, and the level of cash you're holding, plays into that bullish or bearish bias at the time. So we are nimble around having cash. So we're not mandated to hold any particular level of stocks. Now, if the market does look dangerous in our view, then we will go to higher levels of cash. If the market is oversold and looking a little bit scary, then that's when we'll be investing the majority of our money. Right now, as you said, we're pretty fully invested. We've got 12% cash, which is pretty much, we're fully invested pretty much in our view. So we'll be trimming that. So we might, by the back end of April, we might be looking at, cash levels up above 20% or more. So we might be, 30% in cash by the end of April, just depending how far the market runs up until then. Okay. But it's all around flexibility. Sure.
I guess, do you think there'll be a point in time where we could even go higher, 60, 70, even 80% cash? Would we ever go all to cash? Or do you think that, moving forward, if you're in the market, you need to retain some exposure?
Yeah, I think you need to retain some exposure, and it's around the exposures that you retain. So not every stock has the same correlation with the market. So there's some uncorrelated stocks in the market. There's the securities out there that we can purchase that have an inverse correlation to the market. So it's not just around those cash levels. It's how the type of securities that you're holding. You look at some of the high beta stocks, and when I say high beta, they track the market very closely, or they move up and down more so than the market does. Macquarie's a high beta stock, for instance. So it's around those stocks, getting the stocks right for the period in the market you're in, and also having the flexibility with cash levels that you've got at that particular time.
Okay, just wanted to delve deeper into something that we hear a lot, speaking to investors day in, day out, and it's around buying a dividend stock or a stock that pays a yield that is substantially higher than the cash rate. There is a mentality out there that people are just happy to buy these stocks at any price, because if they buy them, they're going to get 5, 6, 7%, and they're going to get their franking credits. Whereas if they've got money in the bank, they're only getting, what the cash rate's 1.5. Term deposits, the max you're going to get probably slightly over 2 at the point in time. Just wanted to really sort of delve deeper into the mentality and why we don't do that, and how that's worked well for us.
You've got to have you've got to understand that dividends are a pass-through of earnings. So, there's no point. Telstra, for instance, this is a really good example. So, Telstra in their last update, they had earnings per share of 14.8 cents, and they paid a 15.5 cent dividend. So therefore, they're paying
borrowing to pay that dividend.
Exactly right. So they're not paying their dividend out of earnings. They're not necessarily, they might have cash on their balance sheet to be able to do it, but if they've got debt as well, it does, infer that they are borrowing to do it. What we want to see, the banks here at the moment. So banks are traditionally very stable in the dividends they do pay, but it's still a pass-through of earnings. Right now, the bank payout ratios, the proportion of earnings they pay out as dividends is high. So they're not going to go higher in the near term. So unless banks can grow their earnings, their dividends won't grow in the very near term. The miners are a really good example here. So BHP, Rio, they had progressive dividend policies. So a progressive dividend policy means that each period they announce a dividend, it's going to be at least the same or more than the last dividend, but they didn't anticipate the big downturn in commodities, and obviously that they had to step away from that. And now they're doing a pass-through of earnings, somewhere between 40 and 60% of earnings in BHP's case. So you just got to understand the underlying metrics of the business, the underlying earnings of the business.
Okay. One other thing I wanted to touch on is a lot of fund managers out there with good reputations. I'm not going to name any names, but there are a few out there that currently have cash levels at their highest possible mandate. Some of these guys have mandates so they can go to 40% cash. They're carrying 40% cash at the moment because they're fearing a crash. Now we've only got 12% cash. Now, the reason for that, I guess, is what? Is it because we're more nimble and we, given that we're not a large fund, we can manoeuvre in and out of stocks, or we've just got a different view, or we don't have a mandate?
Well, we don't have a mandate. They may have mandates, but I don't concentrate too much on what individual fund managers are doing. Each their own, and we concentrate on what we do internally. I think that the main bit of information that we use is the aggregate level of cash in the market. So, at the moment, US fund managers are carrying the highest level of cash they have since back in 2001. I think is the stat there. So we use that. Market tops don't traditionally happen when cash levels are high.
Yeah.
If you think about the mentality, if you're invested but you've got reasonably high cash levels, you're not going to panic out of stock. So you're going to have give the market a little bit more room to move. If you're fully invested in the market, have really low cash levels, then we call them weak longs. You're going to be weak when the market starts to pull back, and you're going to increase cash levels to where you want to be pretty quickly, and that's how market tops play out. Drops play out. Market tops, on the other hand, are around when cash levels are high and fund managers are chasing performance of the market. So, and that's when big blow-off tops can happen, and I think that's what we're in the process of seeing. I don't think we're there yet because those cash levels are high. But if you look at it, and the market continues to rally, and that fund managers are forced to buy equities, that's how tops form, and that's what we look at.
Okay, so just wanted to touch further on that. You're talking about a top forming. What are we looking for? Are we just looking for that flood of cash coming in off the sidelines, and that would pretty much turn us bearish, and we'd probably up our cash levels to 40, 50, even more, depending on what's happening?
Yeah, definitely. So euphoria is the main thing that you look for, really. So market tops are really hard to get a handle on, but you want to see euphoria. Part of euphoria is low cash levels, all in the market, net long, in the market, with the expectation the market's going to rally. It doesn't, then the market corrects pretty sharply. So that's in a nutshell, Nick.
Fantastic. Thanks again for the update, James. As always, anyone watching, feel free to get in touch with us on the 1300 number, which is toll free, 1300 301 868, or conversely, you can reply to this email. Please look out for more videos in the coming weeks.